The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A lack of catalyst leaves markets struggling for direction. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
I'm Alex Steele. We are waiting for some kind of catalyst, that's for sure.
Absolutely. How many days do we have to wait for them, Alex?
I don't know. Is it the jobs day? Is it like a week and a
know.
half at this point? Let's get to where markets stand. Nowhere fast. S&P down about 0.2%. Its volume, though, has been light all day. We're grinding lower to the lows of the session. Volatility absolutely going nowhere. We are seeing selling across the curve, Romaine. You're seeing the back end a little bit higher. So we're steepening now by about 23 basis points. But it's really the back end that's leading it with those higher yields at this point. But nothing going on.
Yeah, a bit of a weak Wednesday if we want to brand it. And really that market malaise today is not really clearly defined by any one thing, but rather a bit of a broader reassessment of maybe economic conditions. It's not recession risk per se, but rather the risk that the cooling economy is left a lot more vulnerable to exogenous shocks. And that's why some investors say, be careful right now about where you allocate into equities.
One of the areas that has done really well is small cap stocks, and they've sort of gotten this push behind them because of rates coming lower. I think that's the area that I would be most cautious of going into the next couple of months.
And that economic cloud of caution may persist until a fresh catalyst does indeed pop up elsewhere. And that catalyst, it might actually be earnings. Believe it or not, we're still getting a trickle of reports from the last earnings cycle. That includes some reports tonight from investment bank Jefferies and memory chip maker Micron. For what it's worth, Jefferies, one of the best performers in the S&P 400 over the past 3 months, while Micron, the worst performer in the Philadelphia Semi Index over that stretch. And when it comes to Micron expectations, they're actually high. Analysts actually foresee strong growth related to the company's high bandwidth memory chips used in artificial intelligence data processing. Positive commentary on that AI demand. Maybe it reinvigorates a chip trade that largely stalled after those mixed reports that we got from Broadcom and NVIDIA just a few weeks ago.
Yeah, and Micron, their outlook in the last quarter was what kind of worried investors. Will that all be enough, though, to kind of stir the pot here for the S&P? The top line here is where the S&P trajectory goes. The bottom line here are the amount of record highs we've seen per year. And you can see we're at 41 so far for the S&P just in about the last 9 months of the year. We're sitting right around record highs. Do we continue to grind that higher? But the last couple record highs have been on pretty low volume and no real catalyst. So are we just kind of melting up here? And what's going to be the next directional point in the market? And to your point, Romaine, will it actually be Micron? And will that reignite the AI flavor?
And what's interesting about sort of, I guess, those oscillations or maybe indecision in the equity space, you're seeing a little bit of that as well in the bond space as well. Let's kick things off to the close right now with Karissa McDonough. She's a fixed income strategist over at Community Bank Trust Services. And Karissa, I do want to start with some of the moves that we've seen in yields since that Fed meeting, moves that aren't quite as definitive as you think they would be, given how definitive the Fed seemed to be about the start of a rate easing cycle. What do you make of it?
Yeah. Oh, thanks so much for having me on. We think, again, after the Fed ended up doing this jumbo cut, which we think was very effective, it was exactly the right thing that needed to occur. We think the 2s, 10s inversion is over. And we do think that, it's not just a bull steepening with short rates coming down. We do think that long rates are vulnerable as well to continue to drift up. As you talked about, you have Moody's saying unhelpful things about the fiscal path of the U.S. economy. Some glimmers of inflation data here and there. So we think that this trend will continue to persist at both ends.
It's kind of interesting, too, like when you go through the Bloomberg terminal and you look at some of the moves that we've seen, not only with the disinversion of the curve, but to that point, sort of what people are buying across the curve. There's been a lot of talk about people still crowded into the shortest of duration, some questions as to why people don't extend duration. Is there some sort of in between here that maybe might, placate everyone?
Yeah, for a long time this year, we had been saying long end, in anticipation of Fed cuts. We're starting to say, the sweet spot is really the belly of the curve. You get a nice coupon clipping. You can benefit from price appreciation as rates come down at the front end, but you're not subjecting yourself to that rate volatility longer term. So that's kind of the in-between that we're looking at this point.
Is it surprising to you, Karissa, that you have rates coming down from the Fed, yet the money in the money market funds is staying really sticky? And when do you think that's going to move, and where does it go within the bond and the credit market?
That's an excellent question. Money market funds, those are going to be crowded out. Eventually, those investors are going to realize that those rates will be kind of dried up, and that's not going to be an opportunity. We think that is also going to come into this belly of the curve trade. We do still see some relative value in credit, particularly bank credit. We think investment grade industrial spreads are extraordinarily tight, but there are opportunities in other safe areas of the Treasury and the corporate bond market to go. And I think that's where they may look at this point.
Yeah, we finally saw Marcus. Did you see this, Romaine? Marcus Goldman lowering their rates.
Yes, yeah,
really
that was
painful.
Quick.
I know, I don't like it. But to your point, it has to come down a little bit more, Karissa, until I'm actually going to move that money out of that Marcus fund. And I'm wondering what you said about credit. Because if I want to go to credit, do I just have to continue to go down the risk curve at that point?
Well, and that's a careful kind of balancing act because, yes, you want to pick your spots. We still like kind of single A bank holdcos, kind of the big SIFI banks, those types of trades. But this is the period of time, again, it's a really transitional period where you don't want to get too careless in terms of your credit exposure because it's really great to get a 6% coupon until that company stops paying. So we caution at this point. It's okay to add some credit, but you really want to be deliberate about where you're adding it. Increasing high yield maybe at this point is a little long in the tooth.
Is that because you have some degree of pause on economic conditions, Karissa?
Yes, that's exactly why. Now, back to our initial conversation on the Fed, they are very forward-looking, and I think that, the data tends to be a little bit belated, but, we're seeing consumer confidence come down. I know that, rates are coming down now, but often, you start to see the Fed cutting maybe 2 to 3 months ahead of recession. So I'm not suggesting that that's automatically where we're headed, but I do think that there are pockets of weakness in the economy that investors need to be aware of.
Well, I'm curious for yourself, when you look at the market moves that we've seen and the participation in the fixed income space specifically that I'm talking about here, do you think that the price action we're seeing is transparent? Is it really reflective of those conditions, or at least how people perceive those conditions?
I think so. There's always a little bit of a lag effect when you talk about risk taking, and I think sometimes people need to be a little bit shocked by. You were talking about events earlier. Maybe there needs to be an exogenous event for people to remember that there is credit risk present. But I think that bond investors try to be forward-looking as well, as equity investors, and so. If the Fed is busy cutting, it's not just, hey, we're going to benefit from lower rates and things are fine. No, I think they are seeing some very concerning trends occurring. And, like I said, there could be some degree of lag or recognition on the part of investors, but we're trying to be forward looking.
So when the back end sells off, is that what that forward-looking scenario is telling you, that it's the real risks in the economy versus equity investors are always going to be more optimistic and are looking at the cuts that will then help the risks in the economy?
Yeah, I think bond investors as a class tend to be a little bit more pessimistic. I'll tell you, I've never seen a total return month like we've seen in September, and I would not suggest that that's what we're going to see for the balance of the year. I think that we are going to see long rates drift a bit higher. Mm-hmm. So. Yes, that's exactly what's happening.
When you look at the Fed messaging then, do you think the market moves to the Fed finally, or the Fed moves back to the market?
No, the market understood that the Fed was serious. The Fed, you can have the most effective policy in the world, but if the market is shocked and awed, then it is not implemented well into the real economy. The Fed's gotten really good at effectively messaging and jawboning. They had all kinds of people in front of the press saying, now's the time for 50 basis points, we need to go big, et cetera. So what we look at is what are implied forward rates looking like and how close are they to the Fed's dot plot. And those are right on top of each other. We're talking about 3% at the end of 2025, a little bit below 3% end of 2026. But the Fed forced the market to come to its level. I know there was some adjustment in the dot plot, but there was a lot more adjustment in implied forward rates.
All right, Karissa, great stuff as always, and wonderful to see you. Karissa McDonough, fixed income strategist over at Community Bank Trust Services. A lot more coming up here on the big program, including bottoms up for U.S. commercial real estate. We're going to talk about why buyers and sellers are convinced that the market's prices won't slide much further.
Plus, closing the growth gap across the globe. We take a deeper dive into investment opportunities and strategies that can further enhance Africa's economic landscape with Runa Alam, co-founding partner and CEO at Development Partners International.
And we're giving you an exclusive look at Meta's first pair of augmented reality glasses.
That
Real
looks so
glasses
cool.
there.
It's cool.
Okay, and if you're wearing them yourself, we're going to actually show you exactly what they can do and, well, maybe when you can buy them. All that and more coming up in just a bit. This is The Close on Bloomberg.
ADRs of software developer SAP down 3% on news the Justice Department is probing the German-based company as well as product reseller Karissa Technology and other companies for potentially conspiring to overcharge government agencies over the course of a decade. Bloomberg's Jake Bleiberg broke the story, and he joins us now. Walk us through this potential misconduct that's being investigated.
Absolutely. Well, thank you for having me. What the Justice Department is investigating is a potential scheme to sort of rig prices by setting sort of competitive bidding at a coordinated level among competitors. And they are investigating whether this went on for as much as a decade in the sales of SAP tech to the U.S. government.
So give us a sense here. There's this company, Karissa, is that how you pronounce it?
Yeah, that's it.
So explain kind of their role in this and the idea that this investigation has been going on for a while, right? We're just kind of learning about the new developments today.
That's absolutely right. So Karissa is a sort of middleman between the government and technology companies, and it helps the technology companies sort of navigate the regulatory maze of selling things to the government. And what we've learned is that on the one hand, there's this long-running civil investigation that dates back at least to 2022 of potential price fixing with SAP. And then separately, just yesterday, the FBI conducted a search of Karissa's offices in Virginia.
How much money is at stake in this? Like, how much money do both of them make, say, from U.S. government contracts? And what's the money about this?
That's a great question. The short answer is they both make a lot of money from selling SAP tech to the U.S. government. The scope of the investigation looks at sales going back to 2014, and it places the overall value of those sales at about $2 billion.
Have you had a chance to actually reach out to SAP? I mean, what do they have to say about this?
We have reached out to SAP. What they told us just this morning was they are cooperating with the civil investigation, and they're not aware of sort of what underlies the FBI's search of Karissa. And we should be very clear, I don't know, and Bloomberg doesn't know at this point, whether the FBI action, that action by law enforcement, is at all connected to the civil investigation that's been going on for years.
How long does something like this typically take? Like, what are we looking at?
It's a great question. The Justice Department tends to move slowly and on their own schedule, especially in sort of complex white-collar cases, as this is, a civil case. I don't know if and when they'll finish their work. And, I should be clear that a lot of times investigations don't end up in any accusation of wrongdoing. We don't know that anyone's going to be formally accused of something here.
All right, Jake, this is a wonderful story. I really encourage everyone to read it. Jake Bleiberg there reporting here on the latest investigation, U.S. investigation, and some of the business practices of the software giant SAP. All right, we do want to change focus here and focus a little bit on the U.S. economy. We are waiting to hear from Vice President Kamala Harris, who is out on the campaign trail as she continues her campaign for president. She's making a stop today in Pittsburgh, Pennsylvania, where she's expected to break down her economic plan at a campaign event there. Bloomberg Balance of Power co-host Kailey Leinz joining us right now here as we take a look at that empty podium, waiting for Harris to take the stage there. And the initial write-up, Kailey, that I saw on this, at least here at Bloomberg, was that this was going to be a little bit more detail on her economic policy proposals, a headline that I feel like I've read several times before over the last few weeks. What's different today?
Well, we are expecting that she is going to, according to her campaign, outline what they're calling a pragmatic economic vision. And that could include multiple parts. Of course, she's giving these remarks in Pittsburgh, an industrial area in a critical battleground state of Pennsylvania. So we do expect the manufacturing economy will be in focus here. The campaign saying she will be talking about incentives to spur domestic manufacturing. We're just waiting to find out the details of what exactly that looks like and how, frankly, it contrasts with the policies that Donald Trump outlined in North Carolina today and in Savannah, Georgia yesterday, in which he's talking about incentivizing manufacturing in America primarily through tax and tariff policies, essentially lowering the corporate tax rate and reducing regulatory burdens for companies that are making products in America and raising tariffs on companies that aren't. And that could include American companies like John Deere. If they make things in Mexico, he says they'll face a 200% tariff on the way back into the United States. So the contrast she'll draw in those policies is what's going to be in focus here. We expect she may also raise things like the care economy. And of course, it comes at a time when polling is suggesting she's starting to eat away at the edge Donald Trump has on the issue of the economy. A new poll from Reuters and Ipsos out in the last 24 hours shows Trump with just a 2-point advantage over her on that issue, 43 to 41%. So that's a much narrower advantage than the 11-point lead he had back in late July when she first entered this race.
I am curious, though, when we talk about these economic policies, and I listened to that Trump speech, and he talked a lot about tariffs as basically being this sort of blunt tool that he would use to solve problems. And we all sort of know the pros and cons of that. When it comes to the Harris approach, though, to addressing let's just call it a downturn that we've seen in manufacturing, particularly in states like Pennsylvania, not just in Pittsburgh, but really much broadly here, has she given any indication as to what the tools that she's going to use are going to be?
Not much specifics. We have heard her talk specifically about smaller businesses and wanting to incentivize their growth through things like greater small business tax breaks. She wants to increase that from $5,000 to $50,000. But we haven't heard much in terms of the wider manufacturing base. She, of course, is going to be speaking from her background, she says, as someone who grew up in a middle class family. That's the message to voters. But this is also not just a message to these blue collar workers who will be voting, but for the corporations as well. As we understand, she's been trying to make inroads in corporate America, having conversations, trying to paint herself as someone who will be pro-capitalist and pro-business. Obviously, it's a tricky line to walk when you are also talking about raising the corporate tax rate, for example, to 28% at the same time that you want to tell businesses you're going to invest in their growth. But what those incentives actually look like, what federal incentives she could talk about here, are what's going to be very interesting. And if they include things like tax breaks that or lower tax rates that Donald Trump is talking about, we just don't know yet. And we're waiting to see how nuanced her remarks today will be in that regard. I would point out, in addition to this speech, her campaign has said she will soon be releasing a big economic policy document that goes into greater detail on her proposals. Unclear whether or not as many voters will read it as, say, us financial and business journalists, but they are saying they will be putting that out there.
Which I also find interesting that it's in Pittsburgh. And I raise the question because green jobs have very much been created under President Biden. But Vice President Harris has not seemed to address that or double down on that in the way that you might have expected if President Biden was, say, still campaigning. And there was a great piece out in the Bloomberg terminal that showed kind of where these jobs are. And they're actually more in Republican states. Do we expect her to kind of walk away from this a little bit?
Well, this is what we've been kind of the dance we've seen Kamala Harris doing throughout the course of her still very young candidacy thus far, still trying to align herself with many of the policies of this administration she's been part of for nearly 4 years, which would be inclusive of the Inflation Reduction Act, the infrastructure bill, some of the legislation that has led to the creation of these jobs, while also trying to essentially chart her own path, or she would say chart a new way forward, as she hasn't wanted to, given the kind of burden of economic feeling around the Biden economy that does exist. She's tried to create some degree of separation. That said, she has, when especially pressed on flip-flopping on green issues, including the Green New Deal, something she's been pushed at as she's carrying different messaging now than she did in her presidential primary campaign back in 2019. She does express that her values around climate and investing in an energy transition haven't changed, but it has been interesting to note how that hasn't been an area of focus for her campaign to this point. And of course, you are absolutely right, Alex. A lot of the actual investment benefits that we have seen have gone to red states and red areas. And of course, representatives from a lot of those places didn't actually vote for this legislation in the first place. And that's something Democrats will be quick to point out as well.
Of course, we're waiting for Vice President Kamala Harris to speak in Pittsburgh at the Economic Club about her economic policy. Just one more question, Kailey, before we go. What is sort of the TikTok now over the next week in terms of where the candidates are going and what they're going to be talking about?
Well, they're still going to be on the move, but probably the biggest event over the course of the next week is going to be next Tuesday, when in New York, where you and Romaine are, the vice presidential debate will happen on CBS between J.D. Vance and Tim Walz. And that actually could be an area in which we get more policy as well, as J.D. Vance has been much more of a policy messenger by and large than Donald Trump necessarily has been himself, although they aren't always in sync, it seems, on a lot of those policy ideas. But you can expect a lot of, especially given J.D. Vance's background in Ohio and Tim Walz's background in the Midwest as well, some of these economic questions to come up, and they will have to defend a lot of these economic policies and their potential ramifications as well. So that's going to be a big thing to focus on. And of course, we'll be watching for the presidential movements as well. And Harris still wants to campaign or debate Donald Trump rather again one more time prior to this election. It's unclear at this time whether or not he's actually on board with that.
All right, Kailey, thanks a lot. We truly appreciate that. Bloomberg's Kailey Leinz joining us, and we are waiting for Vice President Kamala Harris to speak in Pittsburgh, Pennsylvania, to the Economic Club of Pittsburgh. Romaine.
Meanwhile, we turn back to the markets with the majority of the individual stocks moving lower here on the day. We're actually going to take a look at some of the big movers when we come back after the break, including names like DoorDash, names like Tyson, names like HPE, the stocks moving on the back of analyst recommendations. Top calls up next. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with DoorDash, an upgrade to overweight from sector weight over at KeyBank Capital. The analyst there, Justin Patterson, saying he's growing more comfortable about that DoorDash consumer. He also says that his survey is showing continued gains there in food delivery usage. Next up, let's take a look at HPE Enterprise, upgraded to overweight over at Barclays. The analyst Tim Long says buying HPE is the best way to invest in the emerging trend of enterprise recovery, given it lacks an AI premium compared to hardware peers. He also expects more growth from AI server revenues, as well as the company's deal to buy Juniper Network. So shares up about 4.5% on the day. And finally, Tyson Foods getting grilled today. This after Piper Sandler downgraded the company to underweight. The analyst says the rising cost of cattle that's creating downside risk for beef prices, saying falling chicken prices not helping matters either. Those shares down about 4% on the day, and those are some of our top calls. What are you, chicken, beef, fish? What are you?
What's for dinner?
Pork. Pork. And I don't think pork's doing any better.
I like it all.
Yeah.
We don't really cook beef, though, or
Yeah.
meat. My husband loves chicken. It's like every night, chicken. I'm like,
Chicken,
I hear you
yeah.
chicken, but like, please, something else than chicken.
I gotcha, yeah.
You?
Have you tried tofu?
I can't do it. It's a texture thing. You?
No, just salad.
Just salad.
You know me.
Just salad?
And bourbon.
I don't know. He likes gummies, too. All right, come on. Not the sugary one. Anyway.
I'm not supposed to be eating those.
Fabrications for long-term opportunities. We'll break them down. This is Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Volume light. Equity is really going nowhere. Truly looking for that next catalyst.
Do you know where most of the excitement is going on right now? Apparently in the streets of New York. I don't know how you got into work today, but we have the UN General Assembly here, which means, all the presidents and the dignitaries are in town, which means us plebes, basically just get completely shut down.
Oh, yeah. Then we have to walk
Yes.
the 7,000 steps in
That
heels.
is right, and you did that in heels. Well, I did it in flats.
I know,
so,
but
sorry. All right.
enough.
But anyway, there is some good news coming out of these events here. And of course, there's been a lot of talk about investing in emerging markets. And there's a new initiative to bring electricity to more than 300 million Africans by 2030. That's already underway. And the Rockefeller Foundation is on a mission to help secure more funding for that program. The foundation's senior vice president of power and climate caught up with Bloomberg's Jennifer Zabazajah about the importance of private market investments for these types of programs. Take a listen.
This is going to take a lot of coordinated action from both the private sector as well as the public sector. And when I talk about the public sector, obviously, first and foremost is governments in Africa who want to deliver reliable, clean electricity to their residents to their businesses in order to spur economic growth. Look, I mean, Africa has a historical contribution to climate emissions of just 3%. It has massive needs in terms of energy in order to grow the economy. This is going to create opportunities for businesses both internationally as well as domestically to be part of that growth story. And so when we talk about electrifying the continent, it is really about moving the economy forward in a way that we haven't seen in the last 20 or 30 years, and taking advantage of the opportunity that the new technologies to do with solar technology, wind, battery storage, etc., can bring, not unlike the way mobile telephony did, 15 to 20 years ago on the continent.
Ashwin Daible there, speaking a little bit earlier on Bloomberg Television. Joining us right now in studio is a pioneer in this space. Runa Alam is the CEO and co-founding partner at Development Partners International, which focuses on closing the global growth gap through investments in African countries. She should also point out she sits on the Future Challenge Committee, which of course seeks to create investments along the UN's Sustainable Development Goals. You're in town for the UN week here, all of the investments, all of the discussions. We hear this every year. Are we seeing more money put where people's mouths are?
I think we're starting to. I mean, it's still a problem. There's still a real funding gap in Africa. But I will say, like you said, while the politicians, the world leaders were talking in the General Assembly at the UN, there has been enormous activity in the private sector side here in New York. So Milken Institute, World Economic Forum, Prosper Africa, Unstoppable Africa have all had events. And what you find in them is really some of Africa's leaders, Aliko Dangote, Tony Elumelu, investors like me, all gathering and having the proper conversations as to why invest in Africa, the returns in Africa, and that it is an investable destination. What that means is that there really is now more talk about this, and maybe some of that will really come into investments.
Where is the money going, or where will it potentially go? What type of sectors, I think, are offering, the most interest?
For us, the most interesting thing is focusing on the African consumer. Huge population growth, huge income increases, urbanization. The African consumer still doesn't have the goods and services that consumers in other parts of the world have. And of course, when you're focusing on all of that, what that means is that there's a gap and we have lots of customers.
We're in conversation right now with Runa Alam, CEO and co-founding partner over at DPI. But Alex, I think we do have to get back out to Pittsburgh for some breaking news.
Let's go to Pittsburgh, Pennsylvania, where Vice President Kamala Harris is speaking on her economic policy.
For all these positive steps, the cost of living in America is still just too high. You know it, and I know it. And that was true long before the pandemic hit. Many Americans who aspire to own a home are unable to save enough for a down payment on a house, and starting to think that maybe home ownership is just outside of their reach. Folks who live in factory towns and in rural communities, who have lost jobs, are wondering if those jobs will ever come back. Many Americans are worried about how they'll afford the prescription medication they depend on. All of this is happening at a time when many of the biggest corporations continue to make record profits while wages have not kept up pace. I understand the pressures of making ends meet. I grew up in a middle-class family, and while we were more fortunate than many, I still remember my mother sitting at that yellow Formica table, late at night, cup of tea in hand, with a pile of bills in front of her, just trying to make sure that she paid them off by the end of the month. Like so many Americans, just trying to make it all work. Every day, millions of Americans are sitting around their own kitchen tables and facing their own financial pressures. Because over the past several decades, our economy has grown better and better for those at the very top, and increasingly difficult for those trying to attain, build, and hold on to a middle-class life. In many ways, this is what this election is all about. The American people face a choice between two fundamentally very different paths for our economy. I intend to chart a new way forward and grow America's middle class. Donald Trump intends to take America backward to the failed policies of the past. He has no intention to grow our middle class. He's only interested in making life better for himself and people like himself, the wealthiest of Americans. You can see it spelled out in his economic agenda. An agenda that gives trillions of dollars in tax cuts to billionaires and the biggest corporations, while raising taxes on the middle class by almost $4,000 a year, slashing overtime pay, throwing tens of millions of Americans off of health care, and cutting Social Security and Medicare. In sum, his agenda would weaken the economy and hurt working people and the middle class. You see, for Donald Trump, our economy works best if it works for those who own the big skyscrapers, not those who actually build them, not those who wire them, not those who mop the floors, well, I have a very different vision. I have a very different vision for our economy. I believe we need to grow our middle class and make sure our economy works for everyone, for people like the people in the neighborhood where I grew up and the hardworking Americans I meet every day across our nation. So I call my vision the opportunity economy. And it's about making sure everyone can find a job and more, and more. Because frankly, having a job, I believe, in our ambition and aspiration should be baseline. And we should aspire and have the ambition and plan to do more. I want Americans and families to be able to not just get by, but be able to get ahead. To thrive. Be able to thrive. I don't want you to have to worry about making your monthly rent if your car breaks down. I want you to be able to save up for your child's education, to take a nice vacation from time to time. I want you to be able to buy Christmas presents for your loved ones without feeling anxious when you're looking at your bank statement. I want you to be able to build some wealth, not just for yourself, but also for your children and your grandchildren, intergenerational wealth. And here's the thing, here's the beauty of it all. We know how to build an economy like that. We do know how to unlock strong, shared economic growth for the American people. History has shown it, time and again. When we invest in those things that strengthen the middle class, manufacturing, housing, healthcare, education, small businesses, and our communities, we grow our economy and catalyze the entire country to succeed. I have pledged that building a strong middle class will be a defining goal of my presidency. And the reason But let me tell you, the reason is not about politics and it's not about ideology. From my perspective, it's just common sense. It's just common sense. It's actually what works. When the middle class is strong, America is strong. And we can build a stronger middle class. The American economy, we know this here. The American economy is the most powerful force for innovation and wealth creation in human history. We just need to move past the failed policies that we have proven don't work. And like generations before us, let us be inspired by what is possible. As president, I will be grounded in my fundamental values of fairness, dignity, and opportunity. And I promise you, I will be pragmatic in my approach. I will engage in what Franklin Roosevelt called bold, persistent experimentation. Because I believe we shouldn't be constrained by ideology and instead should seek practical solutions to problems, realistic assessments of what is working and what is not, applying metrics to our analysis, applying facts to our analysis, and stay focused then not only on the crises at hand, but on our big goals, on what's best for America over the long term. And part of being pragmatic means taking good ideas from wherever they come. Listen, you all know my career. Andrea shared it with you. I am a devout public servant. I also know the limitations of government. I've always been and will always be, and be clear about this, I've always been and will always be a strong supporter of workers and unions. And I also believe we need to engage those who create most of the jobs in America.
We're listening right now to Vice President Kamala Harris, of course, the Democratic Party's candidate for president, making an economic pitch at the Economic Club of Pittsburgh and the great state of Pennsylvania there. Kind of short on policy proposals, but certainly laying out, Alex Steele, an ideology of how she would approach addressing some of the economic problems in this country. She talked a lot about her idea of a vision of ownership of the people who actually build things rather than just the folks who finance things.
Bold, persistent experimentation was how she framed it. I don't quite know what that means on a concrete level, but that's definitely the pitch she's making. And then the going forward versus going back, which is how she frames President Trump's policies. Yeah. And of course, if you can continue to listen to her comments, which of course are still going on, by typing live go on your Bloomberg terminal. We'll also continue to monitor this here ourselves. And if she does get into some more detailed policy proposals, we'll of course break in and give you those details as soon as we get them. Meanwhile, we continue to count you down to the closing bells with just about 15 minutes to go. Prior to that, we were in conversation with Runa Alam. She's a development economist who co-founded DPI, which is an investment platform primarily focused on Africa. Runa, thanks for sticking around with us here, and apologize for the interruption. I do want to start off on the development aspect of this, particularly coming off of this speech by Kamala Harris. I know your focus is on African countries, but obviously the U.S. is always going to be the 800-pound gorilla in the room. The U.S. doesn't have a huge investment presence in sub-Saharan Africa the way that it might have had in the past. We've seen China move in. We see even Europe move in a lot of ways. Does that matter? Does it matter to the folks in Africa who maybe potentially their, expat partners are?
It absolutely matters, Romaine. In fact, Africa cannot develop on a path unless the 800-pound gorilla, as you said, is more involved. So yes, why is China there? We hear lots of things. It's because of the African consumer. 1.3 billion people, second fastest growing continent in the world, fastest growing consumer class, Africans themselves. There is a reason to be in Africa, and that is to make money. So U.S. investors, U.S. companies going in there will not only matter for development in Africa, but will matter for the U.S. You say, we're worried about China coming in. What do we do really well? We do private sector investments, building companies, building venture capital really well. If we channel that to Africa, it will matter to Africa, it will matter to the U.S.
How far behind do you think the U.S. and that private capital is when it compares to the money and investment coming from China?
I think it's very far behind. Most of Chinese money is going to the government, to infrastructure, to minerals and mining, oil and gas. That being said, the amount of money coming from China, they just announced another $50 billion going into Africa. Now, $50 billion is nothing when you consider the $300 trillion in the private sector, a lot of it in the U.S. That ground can be made up immediately if there is U.S. policy encouraging investment of U.S. money into Africa.
What kind of sectors or regions are most attractive for the private sector right now?
I think it's, again, the African consumer class, which is a very broad category. Corporations in pharmaceuticals, in anything fast-moving consumer goods, in banks, et cetera, in fintech, any of those areas are good. If you combine the big thing that's happening in Africa, digitalization, you have a superpower there, because digitalization allows in a continent where there is a big pyramid, lower income people, and there's a gap in infrastructure. With digital infrastructure, you can actually get to the African consumer. So any of those sectors, combine it with the new technology.
With regard to that build out, though, we know the potential is there. We know the interest is there. And obviously, you talk about population demographics that might aid that. Are the legal protections there? Are some of the corruption issues that have maybe held back certain African countries, have they been, if not erased, at least mitigated to some degree?
Remain, I've been investing in Africa for 25 years. I can tell you only a handful of times where some of those things have come up and we've been able to solve for them. So there is a group in Africa, those we call new generation managers, managing companies, where you don't find that. So there is enough there, enough companies to invest properly the way we do it in the U.S. and to get returns.
I am curious also, particularly with some of the younger entrepreneurs, the other younger smart folks, if we will, for lack of a better term. A lot of them leave. They go to Europe or the U.S. for school, and they never really return. And they set up companies here in the U.S. and do very well. Is that, quote unquote, brain drain? Has that been stemmed to some extent? Is there a reason for those people to stick around in their home countries?
Well, they not only are starting to stick around, but many of them are coming back. Why? The same things we've been talking about. There's a great opportunity with this huge middle class and consumer class to build companies. If you look at the venture capital area, there are a lot of people like that coming back or staying in the country to build startups. That are very specific to Africa and to getting to that consumer class. We have a company called M&T Holland. A few years ago, it was handwriting microcredit loans. Today, it's a unicorn out of Egypt, and it's going north 1.25 in valuation. That's the opportunity. 5 years, get that done. And you have a lot of talent that's now seeing this and seeing the opportunity. So yes, sticking around, building companies.
What's the best way that you've seen or that you've experienced to de-risk when you're investing in Africa?
Invest with people who know the local area and really think about investing in established companies, also in venture capital, but with people who have a track record.
Runa, this was a great conversation. I really appreciate you taking time to be with us. Runa Alam here in Studio 2 in New York. She's the CEO and co-founding partner of DPI. All right, we are just about 10 minutes away from the closing bells here in New York. A mixed day for markets. Alex Steele, the S&P 500 still holding on to losses for the day. The NASDAQ poking back into the green just ever so slightly. Barely.
And the Russell mid-caps obviously underperforming as well. I am looking forward to Micron. Like maybe there'll be some action then tomorrow based on Micron's earnings. Yeah, Micron earnings come out tonight. And I was surprised at how awful this stock has actually been compared to its other chip peers, and I think a lot of people are hoping to see maybe a little bit more of a boost given out of whatever AI dreams we hear about in the release tonight. Yeah, and again, as we mentioned earlier, like in the last quarter, the number was good. It was the outlook that disappointed. Will it be the same? Will they kind of revise that outlook? All right, let's get right to it. Continue the countdown to the close. Pleased to say Dan Suzuki joining us here in Studio 2. He's Deputy CIO over at Richard Bernstein Advisors. Dan, great to have you.
Great to be here, guys.
Look, what is this market doing? Because we had a pretty sustained rally before kind of we got to the Fed meeting. It kind of had sputtered out because everybody was wanting to wait to see what the Fed has to do. They gave us 50 basis points. We had, I think, a one-day rally or something, and now the market's just kind of in its own way. What's going on?
Yeah, I think we're kind of wandering around in the dark here. I think we know that we got the Fed cut, but we don't think that necessarily the pace is going to be 50 forever. The economic data has been kind of choppy and mixed, so I think the market really just needs to figure out where to take its cues from. So you get these like narrative shifts that 1 week the pendulum swings one way, and then the next week it's swinging the other way. I think we really, what's good is that we're, within the next few weeks, we're going to get a lot of important data that's going to help sort of illuminate the economic landscape, whether that's on the CPI front, on the payroll front, or on the earnings front. We're going to know a lot more.
So it sounds like, at least from an equity investor standpoint, it's still about the Fed and the economy. Is that the best way to read it?
I think the market is very focused on the Fed and the economy. We're more focused on profits, which is why earnings season is going to be a lot more pivotal for us. On the Fed, I think the market always tends to overestimate the impact of the Fed. I mean, you just think about the last few years. We've had this historically tight, Fed policy, but we've had tons of liquidity, right? So clearly they're not the big driver of liquidity here. So when the Fed goes the other way and eases, is it going to be the main driver, or are there those other factors that are going to matter more? With regards to the economy, I think the pendulum has swung to a pessimistic side, thinking that we're falling off a cliff here. I think we're slowing, we're easing, but I think it's going to be more gradual, as it usually is.
So just to update you, we were bringing Vice President Kamala Harris' economic speech in Pittsburgh earlier. We are getting a little bit of details about her economic plan. She's looking to give new homebuyers a $25,000 down payment assistance, also creating a $6,000 tax break for new parents, would be significantly higher than where they are right now. And then she says she'll take on corporate landlords to lower housing costs. Now, Dan, this ties kind of directly into sort of earnings. Because if we don't know what corporate tax policy is going to be because of the election, how do we know what earnings are going to be over the next few years? And then how do you model that?
Yeah, I don't think we do, and I think.
So how do you de-risk that?
Yeah, the market is notoriously bad at discounting what the future tax rates are going to be, and I think it overemphasizes the impact of who's president. And I think obviously we know from fact that tax policy is hard to change, and you need Congress and the White House on board. So I think it's very difficult, and so the extreme talks of extreme tariffs and extreme changes in taxes, I think you always have to discount those a little bit.
So if we look at the bond market then as, say, that's where the recessionary, that's where the economic fears might be, but you're looking still at earnings.
Markets, by the way,
right, no, not in credit markets, but then with earnings, and S&P, we've still 41 records so far this year, and one of them was yesterday.
Yeah.
So we can't say that the equity market is discounting any kind of economic.
Well, I think it depends on how you look at it. At an index level, yes, but as we all know, it's been a very narrow, it's been broadening. But a lot of what's driving that has been very narrow. And so if you look at cyclicals versus defensives, or mega caps versus everything else, you get a very different story. And I think some of that, to some degree, is fair, given that the earnings story hasn't been broad thus far. Our take is that earnings fundamental story is going to broaden out, and that's going to drive the broadening out of the markets, and hopefully that'll show the world that profits are actually quite healthy and have some room to run. But I think that's what the market's waiting for.
When you say broaden out, we're talking about going down the spectrum in terms of market cap. So it's not just going to be the big cap names posting these great revenue numbers, these great margin numbers. We're going to start to see that maybe a little bit more on the lower end.
I think every slicing and dicing you want to do, Romaine. So market cap spectrum, regionally, sector-wise, it's been very narrow. And so I think as you see more sectors participate, more regions participate, I think that'll be critical here.
A lot of investors that we have on this program, at least as of late, when we ask them about their investment ideas, they're much more thematic, less about sort of in the moment, much more longer term trends, whether it's AI, whether it's aging population, things like that. How do you, you and your team, I should say, over at Richard Bernstein, view some of these bigger thematic themes that a lot of people have been embracing?
Yeah, I think those are sexy themes. They're sort of they capture the dreams and imagination of everybody. But I think that people have to understand that people tend to overestimate the impact of these thematic thematic baskets have been the talk of the town for decades, right? If you look at the performance of most of those
There's a whole ETF industry built around it.
Yeah, and so I think you got to be mindful of ultimately what drives stock performance is profits, and so a lot of these don't end up being very profitable, or they're the wrong companies that get discounted. So as a long-term theme, I think there's a couple big ones, right? I mean, I think valuation is the number one predictor of long-term returns. There's some huge valuation extremes we're seeing on both sides. I think you can play those in positioning. I also think that looking at inflation and deglobalization are going to be huge themes. So if you want to play a longer-term theme, I think those are ones that you can play now and are working now.
And how do you do that? Like, what is it? What kind of sectors?
Well, if you want to think about deglobalization, one, there's going to be a huge inflationary impact secularly, not necessarily cyclically, but secularly from that. And so owning things that have inflationary protection, like real assets, or things that benefit producers of real assets and commodities, I think that's one area. Also, just knowing that if we're going to continue to deglobalize, contentions are going to increase, and that means that the bigger, more global the company, potentially maybe more at risk. Some of those companies are.
All right, Dan. Great conversation as always. Dan Suzuki, Deputy CIO with Richard Bernstein Advisors, helping us count down to the close. Alex, you mentioned a little bit earlier, we're waiting for those earnings out of Micron, of course, potentially an AI story. We had some breaking news just a little while ago on OpenAI, their chief technology officer, Mira Murati, announcing that she's actually leaving the company. Sam Altman then following up with the post on X saying that he'll have more to say on the transition plan later. Is this a big deal?
I don't know. Is it? I mean,
she was instrumental in a lot of stuff there. She's been there for a while, so I don't know. Who knows? I mean, her statement was a lot of, I want to spend more time doing other things.
Yeah, I don't know about that one.
All right, stick with
TBD.
us. The full breakdown coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Alex Steele, taking you through the Closing Bell, a global simulcast. It starts right now. Scarlett Fu, back from wherever she was, joining us here in the TV studio. Carol Massar, still here. Oh, but Tim Stenovic, for some reason, didn't get the memo. Stephen Carroll filling in for him today as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Stephen, how's it working with Carol today?
Oh, I mean, it's always a dream. As I said, it's day 3 and we're still friends.
We'll see what happens tomorrow. Pressure's on. Having said that, I'm thinking about the chip sector a little bit. Micron Technology, right? That's going to be our focus as it gets ready to report its earnings after the closing bell. Stock's up about 1.8%. Semi's outperforming as a whole. Stephen, up about 0.7%.
Hey, look, I was excited. We got a 40 and a 41 in terms of record closes. It doesn't look like we're going to get 42, though.
No, it doesn't. I mean, at midday, it looked like there was some potential. The other thing I'm paying attention to, of course, is the 1-2 punch that we got from China with the broad stimulus measures one day and then the rate cut the next day did very little to carry over into U.S. trading.
No, that's why it's sort of like, what are we waiting for? Is it really going to be jobs? I'm obviously interested in Micron also, but that trade of small caps and mid caps that were kind of outperforming has not really measured up anymore.
Yeah, and I mean, and it gets to this whole idea of sort of what the next catalyst is going to be for this market. If you listen to what our conversation with Dan Suzuki, it does seem to be that maybe it is going to be the start of earnings season once that gets going here in a few weeks.
He's an equity guy. He has to say that, right?
He has to say that, and we should also point out that the earnings season from the last cycle is still not over. Micron earnings scheduled for after the bell, as is from the investment bank Jefferies. But before we get to that, let's walk you through the numbers here on Wall Street. A relatively mixed day here. I'm not sure what you can read into it, but the Dow Jones Industrial Average, no matter which way you cut it, is going to close the day down by more than 200 points, almost 300 points on the day, or about 0.7% as we wait for these numbers to settle. The S&P 500 down roughly about 10 to 11 points, or 0.2%. It looks like the NASDAQ is going to just barely hold on to gains, less than 0.1% gain for the NASDAQ Composite, 0.1% gain for the NASDAQ 100. Your Russell 2000, though, that's your big laggard here on the day, Carol, down about 1.2%.
Yeah, Romaine, a bit of a meh day, if you will. You can kind of feel it. But if I look at the S&P 500, folks, most of the names lower today. 369 names losing ground on this Wednesday, 132 to the upside. And Scarlett, you got 2 unchanged.
Yeah, and that's reflected in the sector performances as well. If you look at the S&P 500 and its 11 industry groups, there's 9 groups that are in the red. And the reason why it doesn't really really look like that on the big pizza pie is because tech is up about 0.5%. Utilities also up 0.5%. So what does it say? That the growthiest part of the market and the safest part of the market are both up by 0.5%. Energy, by the way, losing ground by 1.9% as oil prices sink.
You still have pizza on your mind.
I do. He does. Yeah, it's going to be a while.
I always have pizza on my mind. All right, let's get to some of the individual gainers. Meta certainly front and center. We've been talking to Ed Ludlow, you guys too, about the new glasses out of Meta. That stock up about 1.3%. We do have Micron crossing. Do we want to go there first?
Yeah, let's do it.
Let's do it. So Micron fourth quarter adjusted EPS, folks, 6 cents better than the street was expecting, $1.18 coming in. The estimate was $1.12. Fourth quarter adjusted cash flow from operations, $3.41 billion. Slight miss, $363 billion was the street forecast. And fourth quarter adjusted gross margin, guys, 36.5%. That's outperformance. The estimate on the street, 34.7%.
Yeah, I mean, looking pretty solid all around. Of course, the detail that we want to see is where exactly we dig into which bits of the business. What is the HI trade looking like in this front as well?
Yeah, I mean, one thing that people are definitely going to be paying attention to is what it says about it. It's the AI picture, right, for Micron. This is a company that for so long made memory chips and didn't really have a role in the whole AI narrative, and that's slowly changing.
Yeah, taking a look here at first quarter adjusted revenue, it looks to come in about $8.5 billion to $8.9 billion. That is definitely above estimates. But on the flip side, you wind up having some cash flow from operations for the fourth quarter missing estimates. But that outlook, that looks pretty good. Yeah,
that looks good. And I think this is what everyone's looking for here. It's this idea that, AI, that memory chips in and of themselves don't have the same sexiness as what NVIDIA is putting out there. But as you build out these data centers and you hear some of these pie-in-the-sky dreams from OpenAI and these massive things they want to build, well, guess what? You need memory in order to do all of that. So maybe potentially Micron benefits.
All right, so interesting. So we'll continue to keep an eye on it. That stock up 11% here in the aftermarket. All right, I mentioned Meta, of course, their new AI glasses, unveiling new models of its Quest headset. So we've seen that stock off its highs here at the close, up as much as 2.5% today, or almost 2.5%, but finishing with a 1.25% gain. Constellation Energy, man, continues to be among your top gainers in the S&P and NASDAQ 100, just continuing to outperform, up another 3%. Of course, since we got that news that Microsoft going to tap into power, Constellation going to reopen the 3 Mile Island nuclear power plant. I know Constellation Energy, their CEO was on Bloomberg on Monday talking about AI and talking about power. So anyway, continues to be certainly front and center when it comes to investors. Quick check, Intl, also something that investors continue to keep in their radar, up another 3% in today's session. Of course, again, this one we continue to watch to see if ultimately will there be some kind of deal, whether it's Apollo, whether it's Qualcomm, or something else that gets Intl into its next chapter. And just for something different, for those who like sports betting, I got to mention Flutter. It was up as much as 10% in today's session. The company authorizing a share buyback program of up to $5 billion over the next 3 to 4 years, according to a statement. Stephen, that stock finishing the day with a 5% gain.
Yeah, I'm going to take you to car makers for the decliners that we're looking at as well. General Motors, one of those slumping today, down 4.9% at the end of trading there, after Morgan Stanley analyst McDonough warned that cars are too expensive for US consumers and that a price war in China is going to hurt the bottom line there. So even with interest rates coming down, those repayments still too expensive for many consumers, keeping them out of the showrooms too. He also downgraded Ford and Rivian and upgraded dealers, including AutoNations. That's one of the fallers.
Have you seen the price of cars out there, Stephen? I don't know what it's like over in your world where you live, but if you go to a lot here,
I don't know. I live in central London. I can't drive. Yeah.
Okay. Yeah. So you got nothing.
Yeah. But look, I know they're expensive because I mean, look, it's one of the things that we're kind of following, and especially people thinking about EVs and where that goes as well. But look, I'm joined by a bunch of style icons, so I want to talk about Stitch Fix as well. Worst slump in
six. Who are you talking about?
Obviously you.
This sheen that
Have
I
you ever
see
seen
off
Alex
everyone
when she
on the
comes
show.
in? She's like she looks like she's out of like the fashion icon magazine or something.
Oh my gosh, that may be the nicest thing you've ever said to me.
Okay, we'll savor it. Don't drink it all at once.
Make him say it again.
Well, hey, look, maybe you guys don't need the help that Stitch Fix offers some people. Personal styling platform shares down 35% at one stage, down almost 40% at the close there as well. They issued weaker forecast than expected for net revenue and adjusted EBITDA. Props to Yusuf Squali at Truist Securities for getting this pun into his note, talking about material headwinds facing the stock. I liked that. I thought it was a good one. See? Okay, one more for you on homes. We've been talking about falling home sales, of course. But KB Home, after their results, shares shares down as we're looking about 5.4% at the end there. They reported earnings per share. Net orders for the third quarter fell short of estimates, talking about numbers confirming builder margin pressure as well. This is echoing something that we heard from Lennars last week as well. That's another share in focus for us.
All right, just want to hit on yields real quickly before we go back to Micron for a moment. You're looking at yields sold off across the curve. The front end ended up by about 5 basis points, and the back end up similar amount. You had a 2-year auction today that went just fine. Nothing to write home about. And we do get another auction tomorrow of 5-year notes, about $70 billion. No, sorry, $44 billion in 7-year notes tomorrow. Today was that 5-year note auction, did just fine. So we'll see. But that curve continues to steepen. Now we're over 20 basis points, a pretty fast re-rating from the inversion that we've seen.
All right, we do want to go back to Micron. Those are the biggest moving shares in after hours trading, up about 9% here. A beat on several key metrics and a fiscal first quarter sales forecast of about $8.7 billion. But I thought more importantly, they talk about this high bandwidth memory chip, which is I guess what all the investors are focused on. That could potentially be the future of this company, and that does appear to be where Micron's forecast is resting on here. So I guess if this is an AI play, a play that of course is a stock that's down 30-something% over the last few months, and maybe potentially this is it.
All right, just watching. Shares of Micron up about 8.5% in the aftermarket. All right, guys, that's a wrap. Our cross-platform coverage. What did he say? Icons of style?
Style icons.
Tim better
wear
watch
it
out.
with pride.
All right, that's a wrap. Alex is heading out. She's going to probably go do some shopping and build up her wardrobe even more.
She doesn't need to.
Awesome.
That's the point.
She doesn't need to. Scarlett and Romain continuing on TV, and Stephen and I are going to continue here on Business Week. Guys, have a good evening. Catch us tomorrow, though, our cross-platform coverage, same time, same place.
And we continue our coverage right here on Bloomberg Television. Again, a recap of those earnings that we just got out of Micron. The numbers for the fiscal fourth quarter coming in higher than what the street was looking for. Adjusted revenue of about $7.8 billion, adjusted EPS of about $1.18 on an adjusted basis. Both of those beating estimates, but its revenue forecast for the first quarter, fiscal first quarter, that seems to be what everybody's hanging their hats on, a range of $8.5 to $8.9 billion. William Kerwin joining us right now over at Morningstar, technology equity analyst there. And when you take a look at these numbers here, what's the first thing, William, that jumps out at you?
Well, I think the numbers were very good. So the numbers exceeded our expectations coming into the quarter. And really, we just like to put this in the context of what's been going on with Micron over the past few quarters. So this is a long upcycle in the memory market benefiting Micron and its other peers that sell these DRAM and NAND chips. And we expect this upcycle to continue through the next 4 quarters through calendar 2025. So it exceeded our expectations, and we think the momentum can keep on going.
I guess my question to you then is, where were expectations set at? Because we had a mixed reaction to both NVIDIA and Broadcom's earnings, and that reflects how the narrative on AI has kind of shifted in the wake of those two results. So was the bar low heading into these Micron results?
Well, if you had asked me a couple months ago, the bar was pretty high. But then what we've seen over the past couple months is a little bit of skittishness, really about memory specifically, some reports of prices taking some downward pressure and et cetera. So we think expectations over the past month and a half have actually come down. And then what this shows is that the fundamentals are actually still very strong. And again, we expect this to continue for the next 4 quarters.
Well, what I am curious about, too, is this idea that when we talk about Micron and the stock, it's always had a sort of cyclical nature to it. The idea that they get all these orders and then that kind of ebbs and then everyone sort of starts to poo-poo the stock and then we just recycle that, refresh here. Does this sort of new AI world and the new potential demand for data centers, is that going to smooth things out, or is that just going to create even a more hyper cyclical nature to this business and the stock?
Ultimately, we don't think it changes much in regards to the long-term cyclicality. We expect the cyclicality to endure. These memory chips, even as we think about high bandwidth memory, are commodities. There are different producers producing to the same standards. And so what we think is happening right now with the AI demand is that it's creating a particularly strong and a particularly enduring upcycle that can benefit Micron over the next couple of years. But ultimately, we still expect cyclicality in the long term. And that also bakes into our no moat rating on the stock.
All right, I got to leave it there. William, really appreciate you jumping on so fast for us to break down these earnings. William Kerwin, technology equity analyst over at Morningstar. We'll keep an eye on those shares. Of course, having a pretty good after-hours trade here. We'll see if that carries over into the cash market tomorrow. In the meantime, we do want to pivot here, and we want to continue on AI, if you will, or maybe augmented reality, whatever we want to call it. Meta's all in on it, and we're going to give you an exclusive look at Meta's first pair of augmented reality glasses. And that last term is really important there. You can see Ed Ludlow wearing a pair there. We're going to have a breakdown of that when we come back after the break. This is Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic here on this Wednesday afternoon, a day after hitting a fresh record high. The S&P pulling back just a little bit, down about 0.2% here on the day, though we did see a little bit more activity in the NASDAQ and in the Philadelphia Semiconductor Index. Tech stocks continuing to try to lead the charge here. The Russell, Scarlett, though, that was your big laggard on the day, down about 1%.
Yeah, a decided downward direction. Let's take a look at some big movers here. GM and Ford both declining after Adam Jonas over at Morgan Stanley downgraded both. It's a broad industry call here with inventories trending up, credit losses trending up, and a lot of CapEx commitment required for AI development. And also Flutter, which is the parent company of FanDuel, climbing to a record high as it held an investor day, sees the U.S. sports and online casino market reaching $63 billion at maturity. That's up more than 50% from its prior forecast. And of course, that is giving a lift to DraftKings. We should mention Flutter also announcing a $5 billion stock buyback plan.
Yeah, and we should also point out Meta Platforms was actually up about 0.9% here on the day during the cash session. This is also the day where Meta is holding its annual Connect conference, where it's giving a little bit of a peek into some new augmented reality glasses. Bloomberg's Ed Ludlow is sitting down now with the Meta CTO, Andrew Bosworth. Ed.
Television and radio audiences all around the world. We're live in Menlo Park, and I'm with Meta's Chief Technology Officer, Andrew Bosworth. Boz, I understand that over a number of years and at the early outset of Orion, because we've been over the details, I've experienced it, we can talk about that. You basically said to the team, I assign a low percentage chance that this will happen. You've got to this kind of prototype phase, so much so that the stock reacted to it. May I start by asking what percentage chance you assign Orion actually iterating or being engineered towards a consumer product?
Yeah, super high, high 90s.
Super high.
Yeah, no, we already have the next two products in development based on the technology we developed for Orion, and we think this is just a proof of how exciting the future is going to be as these technologies become consumer ready.
You may or may not guess, though, speak to some of the team and know that that's part of the origin story. My understanding is that this is a future behavioral change that humans have to make, right? Right now I have a smartphone, I have a laptop, and that's the price point you want to come in at. One day Orion or its next generation sibling will be priced at a high-end laptop PC. What is that price point? And is, give me something here. Will I be coming back to Menlo in 10 years and finally looking at it in a consumer form? Or is it something more real than that?
Long before 10 years. I think we're more than 1 year away, less than 10 years away. But we have very clear line of sight to a consumer product. The price isn't clear to us yet. One of the big things going from a prototype like this is understanding what can we learn that allows us to simplify, or what do we need to keep in future designs, and that's going to control where the price lands. But we really want to get this into a price point, a form factor that not just consumers use it, but developers want to build for it.
The breakthrough in technology is actually in a material, silicon carbide, that allows for all of this in the lenses. How's the supply chain look like for silicon carbide for somebody that wants to do consumer tech?
Yeah, silicon carbide was the first place we looked for super high index glass that's refractive, and that's really important for what we do for these lenses. I will say it's an incredibly difficult material to produce and to work with. And so we are also looking at multiple different materials that we could use to replicate this functionality, and again, at a hopefully more competitive price point.
I'm trying to sort of think holistically about everything that's happened today. When I moved to California 6 years ago, you were a social media company, and then you got absolutely hammered by the markets for being a very big loss-making unit of a hardware company for the metaverse. Now you're very focused on AI. Which of those is it?
It's all of those. I mean, until earlier this year, Facebook's fundamental AI research group reported to me. And I think it's not a loss, it's an investment. And today you got to see for yourself what that kind of investment can get you. And I think that's one of the things where if you are looking towards the future and you realize these curves kind of overlap one after the other, PC and the internet and phones, there is another curve that's going to happen, and we believe it's spatial computing.
Mark talked about how when it comes to interaction with your AI products, Meta AI, which is now through a generation of Llama 3.2, I think he said 500 million active users. But where are they actively using it?
Well, one of the great advantages that we have is a large and engaged base of consumers who want to use AI, but they want to use it in ways that are really comfortable with them. We already have apps that they're using, WhatsApp, Messenger, Facebook, and Instagram. And so integrating these AI tools into something they already use every day is a way to make it much more accessible and frankly much more useful to them.
But I guess the point of my question is the origin of that user's enthusiasm. Are they people that are principally using WhatsApp, or they're still kind of the legacy Facebook user?
It's across all the surfaces, and the usage differs across each surface. You know, the things that I'm going to ask when I'm on the group chat and I want to ask Meta AI a question turn out to be different than the ones when I'm creating content for Instagram.
For our Bloomberg television and radio audiences worldwide, we're speaking to Meta's Chief Technology Officer, Andrew Bosworth, aka Boz, to the thousands of people that work here. You're a technology guy. You know, go on your Instagram when you're driving to work in your electric vehicle, you're filming the experience through your Meta Ray-Bans.
That's right.
But loads of people just aren't ready for that. And, you know, what is it about each iteration or generation of hardware you bring out that makes you think, okay, this will be it. This will be the year where consumers start filming the world around them and interacting with an AI, a voice assistant through the glasses on their face?
Yeah, these things happen slowly and then kind of all at once. When you can replace an existing use case, people can switch very quickly. For me, at least, having Meta AI Assistant on my Ray-Ban Meta glasses has been game-changing, especially because I have young kids who are constantly asking me questions to which I do not know the answer. On the other side, things like using augmented reality glasses to replace your phone, that's going to take a lot longer. We have to build a lot more value there. And that's where the commitment that we have, frankly, from Mark Zuckerberg all the way down is so important.
I was here 24 hours ago and I was able to try out Orion. I hope the team in New York can pull up the video for those watching on TV. But the frank reality of it is, through the article that I wrote or the piece we put on social media, the world out there cannot get a sense of what that's like until you show them. Is there a way you can bridge it? You know, you said somewhere between a year and 10 years for Orion as a consumer product, but what's your strategy to make people see that this is real?
The good news is full AR isn't the only option. So you take the Ray-Ban Meta glasses that we have, and we've just announced so many new features for today. What if these have a display in them? Maybe it's not a super wide field of view, maybe it's not holograms in space, but it adds to the experience. So there's not just one set of products coming in full AR, there's a whole suite of products coming between here and there.
Boz, I talked about Reality Labs getting, I think I said slammed by the markets, but that was a big preoccupation. The story's changed insofar as, like, the hardware's popular.
Yeah,
you know, Meta
right.
Ray-Ban. Dare I say the P word, profitability of some of the things of which you're responsible for?
Yeah, for us, I mean, obviously the major focus is getting this technology to be great, getting it in the hands of people, and like many Silicon Valley companies, focusing on profitability when we've got the scale with the platform that we believe it's capable of.
Part of the Orion experience is that it's like a triumvirate of pieces of hardware.
That's right.
And you have the wrist part, which controls the hand gestures. It's like a left click on a mouse for the computer.
That's right.
And it got me thinking about other areas that you've looked at. So when is the Meta Watch coming?
The neural interface on your wrist is a perfect place to put a watch. We're one so inclined. And it's also a great way to get AI responses and look at your pictures, now that I think about it. So I think we talk about this as a constellation of devices that work together. So whether you have smart AI glasses like these ones, or you have full AR glasses, whether you have a watch or a wristband, when you've got the compute, whether it's on your puck or some other thing, they all work together in concert to deliver this amazing experience.
As we work towards this idea that Meta's an AI company, where do you want to see the investment? A lot's made of how many NVIDIA GPUs Meta's going to make. I think for you, the relationship with Meta's kind of output's a bit different. Where do you want to see the company move a bit quicker?
very few have benefited as much as we have from Meta's AI investment. I mean, if you think about how we do hand tracking, how we do the SLAM that keeps these things located, how we do not just the assistant on the glasses, but also even the image stabilization we do on the glasses, these are all deep AI systems pioneered by the expert AI teams we have here. In the metaverse, being able to describe a world and having it come to life would really help creators get to the point that we see the metaverse becoming a really rich user-generated world. And so for us, like, we see them as very, very co-aligned in terms of pursuing the same future.
Andrew Bosworth, Boz, Meta Chief Technology Officer, thank you for having us here in Menlo Park and also allowing me to actually test whether the technology works or not. Back to you guys in New York.
Thank you so much. That was Meta CTO Andrew Bosworth speaking with Bloomberg's Ed Ludlow. Romain?
All right, we also have some additional breaking news on OpenAI. The nonprofit status that that company has held, well, it might not last any longer. Reuters is now reporting here that OpenAI plans to remove nonprofit control, give Sam Altman equity in the company, and that the OpenAI nonprofit would also have a stake in the new for-profit firm. Now, this, Scarlett, probably isn't a huge surprise. We've been talking about a lot of rumblings, I should say, have been going about here that this was coming. But now Reuters, citing unidentified people familiar with the matter, saying that they are now going to restructure that core business into a for-profit corporation that will no longer be controlled by its nonprofit board.
Yeah, I feel like this is something we've all been waiting for.
Right.
And maybe it dovetails with the CTO, Mira Murati, now saying she's going to leave the company.
Yeah, there's been a lot of departures here. Obviously, a lot of people who were joined this company when it truly was a nonprofit, not always on board, I guess, with some of the changes that have been made. But like you said, kind of inevitable. That is where we're going.
All right, let's go on now to our top three, where we name drop some of the people driving some of the day's most talked about stories. And first up here is Georges Kern. He's the CEO of the Swiss watchmaker Breitling, and he says he is, quote, quite confident that the luxury industry has reached bottom.
The problem of the Swiss watch industry of many brands is that some of them are dependent on the Chinese market. You need to have a plane with 4 or 5 engines. If one engine doesn't work, just hope that the other 4 engines are working.
So he mentioned the Chinese market, of course. China is the company's second biggest market, about 6% of its sales after the U.S. And like everyone else, Breitling is now looking to India as the next market to really put a lot of its effort into.
And I think it's interesting, too. First of all, is it Breitling or Breitling? I always get that confused.
It's Breitling, but
who knows? But what I found interesting about this story is this representative? Like, is this an economic read, like really high-end luxury watches? I mean, this is like the ultimate discretionary item,
Yeah.
right?
I mean, it could be, because at some point, maybe they slow down buying some watches, or maybe they get rid of some timepieces.
Yeah. All right, another story, another person we've been keeping an eye on. Not a household name, Noam Shazir, but this was an interesting story in the Wall Street Journal here. He was a co-author of this seminal research paper that really kicked off the AI boom. He also used to be a Google employee. He was kind of, I don't know if we say pushed out, but he left, started his own company, and now Google has, bought it back, writing them a check for $2.7 billion, according to people familiar with the deal here. And the official reason for the payment was to license the technology from that new company called Character. So it's kind of interesting. They had this guy under their roof. He left, started his own thing, and now they're saying, hey, we still like you. And he said, you know what? That's fine. Just give me about $3 billion, and we'll let you license
And they
the
paid up.
technology.
And they're like, yes, okay, we will do that. So
Yeah.
this is going to add fuel to that never-ending debate over whether tech giants are overspending on AI. Because, like you said, he was in-house before, and then he actually left because he said that Google was being too risk-averse when it came to innovating and
you heard a
developing
lot
AI.
of this, yeah.
And, well, look, now they're paying for it.
Yeah. $3 billion, 2.7, but, let's just
We round up, right?
Yeah.
Okay, third on the docket here is Jose Andres. He is the celebrity chef. He's expanding to branded hotels with a new project in his adopted city of Washington, D.C. It's going to be called the Bazaar House, and it's a 67-room boutique hotel in the Georgetown neighborhood.
Yeah.
He's partnering with Thor Equities to develop this.
Yeah, this is interesting. I mean, I guess this is like the new thing now. Celebrities are over, like, vodkas and everything. It's just hotels. Like, it wasn't like Tony Robbins is opening a hotel.
Yeah.
This is interesting. I used to live in D.C., and I followed Jose Andres' career as he kind of came up in the D.C. scene. He's done a lot, first of all, and he deserves a pat on the back. I don't really understand this at all. Is this, like, are hotels, like, real moneymakers?
They can be, I guess. I mean, it's going to have a private membership club, also restaurant offerings curated by his group. So that doesn't necessarily mean he's doing everything, he's just curating it.
Okay, so basically a place I can't afford to go to, is that?
Oh, well, I mean, unless you're on an expense account.
Okay, unless someone pays me $2.7 billion for my IP. All right, look, Romain Bostic here along with Scarlett Fu. A lot lot more coming up here on the big program. A closer look here at what's been going on in the real estate space. A couple of interesting conversations up ahead. This is The Close on Bloomberg.
Let's talk about the property market. Buyers and sellers in U.S. commercial real estate are increasingly convinced that the market is bottoming out. Prices are down 19% from 2022 when the Fed began hiking interest rates. But you look at what's happening this year and prices are up 3%. Bloomberg's Natalie Wong covers U.S. commercial real estate, and she joins us now. So, Natalie, whenever we talk about commercial real estate, there's not a whole lot of data that you can really point to. And it's a lot of people saying things and maybe saying it makes it true. But is there any recent data on both transaction volume and value that show that there is a bottoming out taking place?
It's still yet to materialize, but what we have seen that's a shift is for the past 2 years with interest rates soaring, brokers, investors, sellers have all been talking about how the markets have just been frozen. People couldn't agree on where property values were at, and they couldn't price it properly because they didn't know where rates would come in. Now, with more certainty around where interest rates are going to be, with the Fed cutting rates for the first time in 4 years and an expectation that it'll continue to come down in the foreseeable future, people are more eager to put their money to work because they can see where prices may stand in the longer term.
One thing I'm interested about, Natalie, is that we've seen more transactions, and that tends to open up the market too, because you had really no real price discovery for probably a couple of years, nothing reliable at least. But now that you're starting to see properties get listed, some get sold, investors, I would think, would have a better sense here of worth, of value.
Right. There have been a few notable transactions in this past year, specifically for office buildings, which were the most distressed property type across the sectors. We've seen several offices, big offices, trade at less than 50% of their previous value across New York, Chicago, San Francisco, LA. And recently, we've seen a lot more sellers looking to market their portfolios, whether it's loans or buildings. And we're also seeing more bidders return to these deals.
So it's easier to get loans now than it was a few years ago. What does the loan demand look like, especially for new REITs for commercial property loans?
Loan demand is really high because the banks have pulled back over the past 2 years. They had an over-exposure to some loans. If they had more exposure to offices, they were struggling with what to do with those loans because they were troubled. So you definitely have seen more borrowers come out looking for new refinancing as their loans mature. That's led to an opportunity for many firms out there with a lot of dry powder. You have Goldman Sachs and Fortress recently looking to raise money for investors for REITs targeting commercial real estate debt. And then you also have big property titan funds or private equity funds like Ares looking to raise, the biggest property debt fund ever, $3.3 billion that just closed this month.
I'm curious about the complexion also of what's being bought. You also wrote a story that I thought was interesting about a property, I think it was down in Lower Manhattan, that was bought, that basically is going to require a lot of construction to turn into something new, basically an office building that could be converted into effectively residences.
Right. For the past 4 years, everyone's been talking about when are we going to see these old offices that are not being used being converted to residential. Everyone talked about how hard it was to make that work cost-wise. Now we're starting to see an uptake in some of these deals get traded because the offices are being sold for a low enough price that the economics make sense to convert these housing. So recently today we just wrote about financial district office building in Lower Manhattan that's under contract to be sold to a developer who plans on converting it into hundreds of apartment buildings.
Yeah, it'll be interesting to see. I actually stayed in a hotel in Chicago. There used to be an old office building, and they converted it into hotel rooms. It was interesting. I mean, it was a different layout than maybe what you would normally expect, but I could see how it works. Some great reporting by Natalie Wong covering U.S. commercial real estate for us here at Bloomberg. And we do want to stick on that topic and turn to the manufacturers that supply the materials used to make all those fancy buildings and homes. Saint-Gobain is one of the most trusted manufacturers in the construction space for commercial and residential real estate. And pleased to say, joining us in the studio is the president and CEO of their North American division, Mark Rayfield. Mark, great to have you here.
Great to be here. Thank you.
Let's talk about the state of construction here in the U.S. And I want to start off kind of with non-residential construction for a second. I mean, how much activity are we actually seeing in that space right now?
Well, as mentioned earlier, it's been slower in the commercial and the office area in the big cities. But if you get into industrial, so warehousing is quite large. If you get into transportation, airports, hospitals, biotech, still has quite a bit of building going on.
What mainly drives the activity? Is it economic conditions? Is it interest rates? What is it?
For commercial, it's just the general economic activity. So with the general situation we are now with work from home and not as many people coming into the office environment's been very compressed. But if you get to services, if you get to biotech, hospitals, education, airports, that's quite robust.
So you deal with the materials, and I'm curious to hear what the cost situation looks like for the materials, because obviously they'd gone up quite a bit in the years during the pandemic and after the pandemic. Have they stabilized? Have they started to come down?
They've stabilized. They haven't come down. There was a lot of inflationary pressure due to supply chain during the pandemic, and there's still a lot of inflationary pressure over the long term on some of the raw materials involved in the building materials. So they aren't going up at a great pace, but they've kind of plateaued.
And of course, it is Climate Week, and that's why you're in New York right now. So I got to ask you about material that's more sustainable as well. How much more of a premium does that cost you?
It's a great question. There's a slight premium depending on which material you're talking about, but we are building a zero carbon Scope 1 and Scope 2 gypsum line in Montreal using hydropower. That product will be slightly more expensive. It's a $150, $160 million project to redo the line, but it will be able to have no embedded Scope 1 and Scope 2 carbon. So for jobs that are looking for that very sustainable, low embedded carbon, we'll be able to make that product.
What's the demand for that, given the premium price?
There's really not that much of a premium price, honestly, because once the investment it's just the depreciation. So the demand is increasing in the large cities. Like when you talk here, the discussion of changing an office building into a apartment building. If you want to have a lower embedded carbon, that's a great way to do it. You're taking the existing building and keeping it. And so those kind of projects are looking for low carbon solutions.
I remember we had a guest on some while back, and I remember he said that concrete that was one of the most polluting things out there, which it just kind of blew my mind here. And he had a small business that he was trying to find ways to kind of create a more, I guess, sustainable concrete, more environmentally friendly concrete. When we talk about the technology that goes behind this, where is that research coming from? Is it coming from within companies like yours, or is it coming more from the traditional academic and government science sectors? Like, how are we coming up with these ideas of how to make this stuff a little bit more environmentally friendly?
It's a partnership. I mean, our core purpose is light and sustainable construction, so our whole business is focused on decarbonizing the construction industry. So it's what we do in all of our R&D centers. We know that 40% of the embedded carbon or the carbon released is in the built environment. So for instance, in concrete, we have additives, construction additives in our construction chemical business that can drop the embedded carbon by 50%. So there's things we can do, even because concrete won't completely go away. We make lighter gypsum board with more recycled content, fully recycled content in our siding. So we're focused on that through our own R&D and then partnerships with universities.
Romaine asked Natalie earlier about her story on these office to residential conversions, and you mentioned it as well. How complicated is it to convert those office buildings into residential buildings? From where you sit, what's involved in that people don't realize?
I think the biggest challenge is plumbing. Honestly, so generally your office buildings have central areas for your lavatories and plumbing, and when you put in a bunch of apartments, getting the plumbing is the number one, a little bit on HVAC. But as far as building modular homes inside there, modular wall assemblies, and being able to put apartments, very doable. And if you don't tear the building down, you're not taking all of that embedded carbon and throwing it away and starting from scratch. So if we really want to decarbonize, more than electric vehicles, more than anything else, if we can use our existing infrastructure, our existing buildings, and put light and sustainable products inside to convert them, that's the most effective way from a climate perspective.
So why the reluctance from municipalities to do so?
It's complicated.
That's it.
It's complicated.
It's a lot of work.
It's a lot of work. It's zoning. So, if you're in cities, it's a little different with zoning. When you get to smaller communities, it's all about zoning. And then it's a lot of work to figure out how to make the economics work on it.
I do want to ask you about the labor side of all this. I mean, we heard so much about how tight the labor market was overall, but specifically when it comes to construction, whether it's home building or even commercial building here. Has that eased up a little bit? Is it easier to hire folks, or I guess have wages sort of normalized a little bit more, stabilized?
I think it's normalized. I think it's easier to hire folks, but I still think you're looking at a 12-month, if you're doing a home renovation, most places may be looking at 6 to 12 months getting a contractor to sign up, so it's kind of normalized. And I think right now there's enough labor to continue to grow homes. We have probably 5 million homes underbuilt in the U.S. right now, probably 4 million in Canada. So we need to build a bit more than we are now. I think with interest rates, you'll start to see that happen. But the labor's there to do it, but to go much higher, we'll have to bring more people into the trades.
That's always part of it, isn't it? Mark Rayfield, President and CEO of Saint-Gobain North America. How do you say it in French again?
Saint-Gobain.
Saint-Gobain. Okay, we're going to go with Saint-Gobain because we're American. Thank you so much for joining us today.
Thank you very much.
So we had some data on housing today, and it was fairly optimistic, Romain, but it didn't do very much for the market overall. You look at where stocks ended the day. If they rose, it would have been another record high, but we didn't get there. We are down 0.2%, although the Nasdaq did manage to notch a gain.
Yeah, it was interesting, though. I mean, some of the home sales data wasn't that great, but I thought the refinancing data that we saw, I mean, this idea here that interest rates are coming down, and that's, of course, going to be the trigger for not just refinancings, but hopefully new mortgages and more activity in the housing markets here. I know it's only been, a week since the Fed meeting.
But we've been anticipating it for years.
Right, so it may take, the lagged effect may take a little bit while longer, but I think that's what everybody's counting on.
All right, this is The Close on Bloomberg. Google CEO Sundar Pichai says Google's antitrust battles will be a lengthy process, minimizing the business threat that they posed. In an interview with David Rubenstein for an upcoming episode of Peer to Peer, Google CEO Sundar Pichai commented on the federal antitrust trial that's currently underway in Virginia. This is a trial in which the DOJ alleges Google manipulates the roughly $675 billion display advertising market.
That case is just getting underway, so I expect it to take some time. And but look, where we can figure out constructive solutions, I think we will. Where we think it really harms our ability to innovate on behalf of our users, or we are going to be vigorous in defending ourselves, and it's going to take time for it to play out.
And joining us now for more on this is Carlyle co-founder and co-chairman David Rubenstein, who hosts, of course, Peer to Peer. David, thank you so much for speaking with us. And of course, Google faces not just one, but two antitrust battles in digital ad and online search. And if things are going to take a while, I mean, this is an industry in which things move so quickly that by the time there is a resolution, Google will have moved on to the next big thing.
Yes, there are two cases to make clear to everybody. The case in California, which dealt with the search engine, Google lost that case, but the resolution will, in terms of remedies, may take a year or two before the judge decides what they are, and then there will be appeals, and it could go on for 6 or 7, 8 years, who knows. The other case, which relates to the advertising, the way they sell advertising, is going to be moving forward in Virginia. That trial hasn't started yet. But remember, Microsoft lost a case years ago and had to enter into a settlement agreement with the United States government on antitrust charges, and Microsoft today has a close to a $3 trillion market cap. So it's not exactly as if these cases are going to necessarily hurt the company all that much, because it takes a long time. And as you noted, the technology is so rapidly moving that by the time the federal government comes up with what its resolution is, the resolution may not bear any relationship to where the technology is.
Right, and we know that Google is moving very aggressively, as are all the big tech companies, on AI. I'm wondering if Sundar Pichai said a lot about AI and how he's positioning the company given these antitrust battles.
Well, AI is obviously something all the big tech companies are focused on. Google has been criticized by some for not revealing what it had done in AI before. AI really was being developed at Google well before OpenAI was really a company, and Google decided to keep it private and not really make it public. But now they're getting into their search engine, and today, for example, you can go into the search engine the way you normally would, but you also will soon have, and in some cases you may already have, AI components. So if you want to know what the AI answer to a certain question would be, you can do that as well. And both of those will be available to users of Google search engine.
David, how much did he talk about, though, the competition in this space? Because when AI, or at least the public-facing part of AI, really became a thing, Google was kind of afterthought for a lot of folks. It was all about OpenAI. It was all, to a certain extent, even Microsoft and some other companies out there that have their own chat products here. Did he express any concern here about the number of entrants in this space?
Sundar is a low-key person. He doesn't kind of brag about what he's done or his achievements and so forth. So he wasn't the kind of person who would say, we really have a great AI product ourselves. They actually developed really good AI products. They didn't get them into the public domain quite as quickly as OpenAI did, but I think they're now doing that. And I don't think he expressed any regrets. There have been some critics who have said that Google should have been more public about what it was doing in OpenAI, doing it in AI, and probably should have been more competitive with OpenAI. But in the end, I suspect Google will catch up. It's got a lot of resources, and I think while OpenAI is a great company, Google is pretty strong as well.
Well, speaking of competition, in addition to this interview that you did with Sundar Pichai, you actually had a chance to sit down with Ted Sarandos over at Netflix, also for peer-to-peer. And he talked a little bit about how competitive the streaming landscape is now, kind of drawing that line, that arc of really that house of cards, which really made Netflix what it is, to today where, you know, there's, I don't know, I've forgotten how many streaming services exist now.
Well, when they first started the company, remember in 1997, they basically got DVDs to people, and their novelty was mailing them out by FedEx as opposed to going into a Blockbuster store. They always had the idea of doing streaming, and nobody took it seriously. When they started streaming, there was no competition. When competition realized what was going on, they moved into the streaming space, but Netflix is so far ahead of everybody else that they have a dominant market share, not dominant in the antitrust sense, but a very large market share. They now have 275 million customers around the world, and it's something that everybody seems to have a Netflix account, seems to like watching it. And Ted Sarandos is a person who started out at a video rental store like a Blockbuster, and ultimately got to be well known for his reviews of the rentals that you could rent, the videos you could rent, and ultimately made a connection with Reed Hastings, who had built and started Netflix, and the result was he got hired, and now he's the co-CEO. Reed Hastings has retired, and now Ted Sarandos really spends most of his time, or a lot of his time, on developing the programming. And their novelty was developing their own programming. Originally, they were using Disney's products or Paramount's products. Now they basically developed their own programming, and the most famous of one of which initially was House of Cards, which they spent $100 million on before it was actually produced. And it was a big risk. He thought he might get fired if it didn't work out. But in the end, it worked out, and now people spend a lot of time doing what's called binge watching, which is to say watching serial parts of a set or an episode. They might watch 3 or 4 episodes at the same time, or not the same time, but in sequence. So Netflix has done extremely well, and I would say that nobody is even close to catching up with them in the streaming world so far.
Yeah, it's quite a story, and really pretty remarkable what they built, and particularly given the origins of Reed Hastings' sort of almost just cockamamie idea, and then of course Ted Sarandos coming in and really turning it into something else. David, really appreciate you taking time for us. David Rubenstein, he's Carlyle co-founder and co-chairman, and you can actually watch both of the interviews that we just talked about. They are on David Rubenstein's show, Peer-to-Peer Conversations. That interview with Ted Sarandos, that airs tonight at 9 p.m. New York time on Bloomberg Television. And that interview with Google CEO Sundar Pichai, that first airing will be on October 9th, also right here on Bloomberg. All right, when we come back, we're going to set you up for some of the potential market-moving events over the next 24 hours. This is Bloomberg. All right, let's talk about airlines, because tensions are escalating ahead of Southwest Airlines Investor Day tomorrow. Activist investor Elliott slamming the airline for its, quote, reckless and chaotic recovery strategy. Joining us right now is Bloomberg's U.S. Airlines reporter, Mary Schlangenstein, joining us now to talk a little bit more about this. And Mary, I mean, we kind of know what Elliott wants overall, but have they been very specific about what they want that strategy to actually be?
They haven't been too specific to date. What they're saying is they would bring in their slate of managers, or their slate of proposed directors, and then they would have a group of people that would assess what to do next, what steps to take going forward with the airline. They have mentioned, the possibility of charging for bags, because that would be a big revenue producer. Premium options that Southwest says it's already considering, and assigned seats.
I don't quite understand this, though, Mary. I mean, as you know, what made Southwest was kind of the simplicity, right? No bag fees, no real assigned seating. It was just simple, and it was cheap. If they're just going to become just like Delta or United or any other major airlines, what differentiation are they going to have in terms of their business model?
Well, we think that the airline itself is going to hang on to bags fly free policy, because that's the one huge differentiator that sets them apart from everybody else. And so they're going to try to hang on to that, although they have been asking customers about, whether they would pay for a bag if that was offered as part of a bundle. So we think they're going to keep that, but they're just being forced through growth and through changing customer preferences to have to offer some kind of a premium option and to offer assigned seating.
You said a bunch of people will discuss proposed changes or changes that Southwest can make. Would that group of people include the current CEO, Bob Jordan? Because Elliott is looking for him to go out, to leave.
Yeah, Elliott has been adamant that Bob Jordan has to go as CEO. Southwest board has rallied around Jordan and said, no, he's not going to go. That's not negotiable. As we know, the chairman of Southwest has already said that he'll step down next year.
Very quickly, Mary, you also wrote a story today about how Southwest has made a number of changes to flights, and basically Atlanta flights are going to be cut way down.
That's right. They got into Atlanta in 2011 when they bought AirTran, and they've kind of struggled off and on with Atlanta since then. And what they've told employees is, look, we're not making money on these flights. We have to change things around to where we're making money. And so a third of the flights in Atlanta have got to go. The jobs of 130 or 140 pilots and 200 flight attendants are going to be affected. Although the company says they won't be laid off, they'll be offered transfers.
All right, Mary, going to have to leave it there. Of course, all eyes will be on that investor day tomorrow for Southwest Airlines, one of the potential market-moving events to keep your eyes on. Here are a few others as well that you should also pay attention to, and that includes some earnings tomorrow, Scarlett, out of a couple of key companies.
Yeah,
the C's.
A read on the consumer here, too. Another C for you. Costco and CarMax, and of course, my favorite shopping destination.
Yes, yeah, so you are like a titanium member or something like that. While you were away, we had a whole discussion about you, why you're not sharing your membership with us, because they're checking IDs at the door now.
Yes, they are. Yeah, it'd be hard to do that.
All right,
I don't want to get in trouble with them.
Yeah, right. Don't mess with Costco. And we're also going to get some economic data in the morning as well.
Yeah, we have durable goods, which is notoriously volatile, jobless claims, which takes on extra importance given that everyone's waiting for the next Fed rate cut and whether it'll be 50 or 25 basis points, and pending home sales at 10 a.m.
Yeah, that could be interesting as well, given all the discussions we've had today. We were just talking about it, the Southwest Airlines Investor Day kicking off at 10:30 a.m. Eastern Time. Of course, they're headquartered in Dallas, I'm told. And we got Fed Speak, Scarlett. You've been gone for like a week and a half on your European vacation. Did you miss all the Fed Speak?
Oh my gosh, there's so much to make up for the fact that I haven't been around for the Fed Speak, right? Collins, Kugler, Bowman,
Williams, Barr, Cook, Kashkari, and Powell.
It's an embarrassment of riches.
It's like the entire FOMC there. That does it for us here on The Close. Join us tomorrow for all your markets coverage. Balance of Power is up next.